start by explaining the simple interest calculation. The concept is very easy, that whenever we need to calculate interest, we have to refer to the initial deposited amount at our account. So if you would like to calculate the interest of the first year, you have to calculate the interest based on the initial deposit amount at the beginning of your investment. And whenever you need to calculate interest for year number 10, for example, you need to base or refer your calculations to the initial deposited amount in the account. So let's take example. Assume that we are going to deposit $100 at our bank for 1 year, and the bank agreed to give us 10% as an interest rate on our deposit. Now let's answer two questions. Question number one, how much interest did we earn on our deposit, or we are going to earn on our deposit in the bank for the first year? And the question number two is related to our ending balance of our investment at end of the first year. Let's start by answering the first question, which is how much interest we are going to earn on our investment. The interest will be based on the initial amount that we deposited in the bank, which is $100. So we are going to say we deposited in the bank $100 for 1 year times the 10%, which is the interest rate. So the interest in this case will be $10. Type. For the second question, how much is the ending balance? The ending balance will be two things. The number one, which is the principal, the amount that we deposited in the bank at the beginning. So this amount initially deposited is called the principal. So how much is it? It is $100. In addition to the interest that we earned on our investment, the interest here, which is $10 that we have just calculated, so it will be $10. So the result of the ending balance at our account at end of the first year, it will be $110. This will be the ending balance of our account, or at our account after the end of the first year. Now let's continue the example, and assuming that we are going to deposit the same $100, but not for 1 year, but it will be for 2 years. So this will be the first year and this will be the second year. Again, the bank agreed to give us 10% on each year. We have to answer the same two questions again. Number one, how much is the interest? And question number two is how much is our ending balance? Regarding the interest in the first year, it will be the same. In the first year, it will be the same. How much initial amount we deposited? It's $100 times the 10% equal $10. Equal $10. This is our interest, exactly like what we have calculated here, which is $10 here. Type. When it comes to the ending balance in the first year, we are still in the first year, so it will be the principal plus the interest that we have just earned, which is 10. So the ending balance at the end of the first year, it will be $110. This is our ending balance at the end of the first year. When it comes to the second year, we are going to calculate the interest again. For the interest for the second year, under the simple interest calculation, you need to refer to the initial deposited amount that you deposited in the bank at the beginning of your investment, which is $100. So you have to multiply this $100 times the 10% that the bank agreed to give it to you. So this will be the same $10 that you earned in the first year. This will be the same interest that you are going to earn on the second year. So the simple interest calculation assume that each year you are going to earn same interest, because actually you are basing your calculations on the initial deposit amount at your account at the beginning of your investment. So the $10 here will be the interest of the second year. Okay, when it comes to the ending balance, at the ending of the second year, it will be ending of the first year, which is 110, plus interest of the second year, which is $10. So the final ending balance will be $120. This will be the ending balance at your account at the end of the second year. And in other words, if you would like to calculate this $120, it will consist of three things. Number one, how much amount you deposited initially at our bank. It will be $100 at the beginning of your investment, plus the interest on your first year, which is $10 interest on your first year, plus the interest on your second year, it will be the same $10. It will be the interest of the second year. Adding all together, it will be 120. It will be the ending balance at your account after the second year. Now, if you are going to calculate the interest for 10 years under the simple interest calculation, so again it will be the same. How much principal you earned, how much principal you deposited at your account, it will be $100 plus interest for 10 years. How much is the interest for any year? It will be $10. So you are going to multiply 10 times number of years, which is 10. So the interest will be $100 plus the principal itself, which is $100 again. So the result will be $200. This will be the ending balance of your investment at end of last year, which is year number 10. This is the ending balance of year number 10. Let's remember it because we are going to compare with the compounding interest calculation. Before going to explain the compounding interest calculation, let's review some terms that we have just explained. We explained that we have something called the principal. This is the initial deposited amount at your account, and in our case it was $100. And we explained also that we have something called interest rate, which is the 10% the bank is giving us on our investment. And I'm going to refer to this interest rate by R. This is the interest rate term. And for the principal, I'm going to refer it to P. And for the number of years, whether you deposited your investment at your account for 1 year or 2 years or 10 years, I'm going to refer to the number of years. I'm going to refer it by N. So these are the three terms that we have just explained in our example.